The journey that a private company takes in listing itself on the Colombo Stock Exchange could be a smooth one if you have the right information. On that note, welcome to Going Public, a show which explores this very journey that a company takes when transforming itself from a private company into a publicly listed one. Now, during the past weeks, we have brought you industry expertise to help you make better decisions when it comes to the future of your organization. Going Public is a collaboration between the Securities and Exchange Commission of Sri Lanka, the Colombo Stock Exchange, as well as NTV Sports. On that note, I'm going to hand you over to the very capable host of the show this evening, Mr. Vasula Premavardhana, former director of the SEC, as well as a capital market specialist himself. Over to you, Vasula.
Thank you, Amaya. Here with us today is Mr. Darshan Pera, CEO NDB Investment Bank, Mr. Shahan Kure, Vice President Corporate Finance Equity Partners, and Mr. Deshan Pushparaja, is Head of Investment Banking of Capital Alliance Partners Limited. Welcome to Going Public. Just to start off so that everyone is on the same page, can you describe what is an investment bank?
Well, investment banking is pretty much involved with providing the full spectrum of financial services to companies which are A, looking to raise capital, or B, looking to invest capital, or C, trade in them. So a typical investment bank would include managing other people's funds like wealth management, trading rooms such as trading in bonds, trading in secondary market stocks, as well as actually helping companies raise capital. In relation to raising capital, investment banks advise on both raising debt when a company wants to raise fixed income as well as raise equity. When it comes to the substance of our discussion today, an investment bank advises or its involvement in an initial public offering is twofold. One is in relation to advisory, and the other is actually raising the funds. When a company comes to an investment bank and says we need capital, the investment bank initially would advise the company on what needs to be done before you can go public. A lot of companies in Sri Lanka are family owned, so a lot of work needs to be done beforehand to prepare a company to actually go out into the market and raise funds. And once that is done, then it's the job of the investment bank to actually go out and actually raise the funds for the company concerned.
Anything that you want to add to that, or that covers everything?
In a nutshell, I think that covers most of it. With regard to if you go into details of carrying out IPO, I think probably we'll discuss later subsequently. But the role of an investment bank, I think Deshan has come up with a solution.
So let's starting with how investment bank can help a company list. What are the kind of options that are available for a privately held company to get listed? And what are the options available for funding? What kind of capital do you all actually raise?
Initially private companies would need to be converted into public limited companies before they can be taken to the market. But the three methods we have in Sri Lanka of listing companies are what's called an offer for subscription, which is where a company would issue new shares to the public, and the money that is raised by issuing those shares comes into the company, which it can use for expanding its activities or investment or whatever. IPO. Yeah, well, that is also an IPO. Also, you can have an IPO through an offer for subscription, which is where instead of raising new money into the company, the existing shareholders of the company will sell some of their shares to the public through a public issue. So that is also an IPO. That money, of course, won't come into the company. It will go to the shareholders who are selling, and you can have
like a kind of where you will kind of give to a private
No, it is also an IPO. So, for example, if you take the Sri Lanka Telecom IPO, that was a offer for sale, because what happened was that the government sold down part of its shareholding in the IPO, so that money didn't go into the company, if I'm correct. I mean, you can also
some
have
people divested.
Yes, correct. It's a divestment.
IPO. Okay, fine.
So also you can have a combination of offer for subscription and offer for sale, where you raise some new capital into the company and the existing shareholders divest part of their stake as well. And also in Sri Lanka we have what's called listing through introduction, which is you don't raise any new money into the company, and no one
but that is provided you have either a parent company or your company already a part of
no, that is provided that the company has what's called a tradable free float of 10% for listing on the second board, or 25% for listing on the main board.
Yes. So how does the process start? Does a company come and tell you we want to get listed, or we want to raise capital, or it's a combination of one of those two?
I think it's a combination of both. Sometimes we have seen people coming specifically asking for listings, and some instances we have seen people asking to come and raise money. So then we would actually look at what options are available for raising money, whether it's debt or equity, and then we would accordingly advise them. So if it is equity, then we would look at to see whether the company is prepared or ready to go for public, and then if it is so, yes, then we would take on the assignment to list. But otherwise, then we would look at other options available, say like private equity or pre-IPO placements, where it might not be the correct time for a listing, but might have to go through a private placement prior to that to see that the company raises the required money, and then
raises itself
so that they can actually go for a listing subsequently.
Like Darshan mentioned, an IPO is not always the best solution. There are other solutions out there, so it depends on at what point of its cycle the company is.
So walk us through the process. For example, you're a startup, or you have been in operation for say 4 or 5 years. You have a set of books, and you have a story, and you're doing all right. So now the next stage is more money necessarily. I presume in a situation like that, it's basically money first, listing second, whereas perhaps you might be in operation for a while, and then you might want to get listed because you want to start, as one of our previous guests said, a relationship with the market, so that when the need arises to go to the capital market, then you can do so. So in that process, so the private placement or angel investors or whatever you can call them is the first step of finding capital. But let's say we have done all that, and now you're at the stage of wanting to get listed. So how does that work out?
Well, in terms of, I guess, when you start off, it's always an angel investor that you're looking at. But as you mature, the options out there for you are private equity and an IPO. When it comes to choosing between the two, it's really one more of an emotional readiness as well to actually go out into the market. People do have this concern that they would be divulging too much information maybe too soon, which is not really the case, but it takes time for people to get comfortable around actual disclosures, investors questioning their moves. So in that case, it's good to have one professional investor like a private equity investor on board, because that actually brings the company into line, gets systems and processes in place. A lot of times, especially in family run businesses or owner driven businesses, you don't view the owner as separate from the company. They are viewed as one and the same. Whereas when you do have another third-party investor on board, you are forced to think of the company as a separate entity altogether. You are thinking what's best for the company, how do you structure the company, the systems in place. You might have to report to the third-party investor as to how you are doing. So the private equity investor coming on board actually prepares the company for them. Now, some companies are already streamlined enough to have actually bypassed that stage, because some companies are run that way, where there's professional management on board and information systems are there, in which case you can go directly into an IPO. So it's not really as to how many years you've been in existence, but at what stage of that cycle you are in to be emotionally ready to actually go out and go to the public.
Right. So is it also emotional readiness, and how about the actual process of processors being present?
Yeah, it is also the processors as well.
So how does the investment bank, I mean, are they advisories to prepare in the company, or are they advisories to actually just taking it public? Who comes and trains a company who may not be aware of, you know, the whole process, that post-IPO process, the preparation, which is what, you know, probably this is the most fearful step for most people. You know, perhaps losing control, so on and so forth, is also one part of, you know, their fear factor. But just the process-wise, so who advises a company that has no experience being listed? Is that a part of the investment banking advices?
Yes, it theoretically is. Depends on the relationship that the company has with the investment bank. Typically, in most cases, investment banks do get involved with companies long before the IPO, and then would advise them through this process of investment banks themselves are not the professionals in these specific areas, but they would guide the companies towards the right parties to look to in terms of systems, processes, and getting things on board. And certain cases it's transactional. Certain cases the company wants to do an IPO, and in which case then the investment bank gets involved and runs them through that process. So it's really a relationship driven thing.
Darshan?
I think it's mainly that would be a part of the investment banker's role actually to prepare a company that's going public. As Deshan correctly mentioned, you have to put the house in order first. So accountability, bringing in accountability, transparency, governance into the system, that's key things that needs to be there before going public.
So in your general experience, how long a process is that?
Sometimes it can take over a year or two. We have had the experience where we had been working with the clients on these systems and trying to gear the company before they could go into to the public by improving their systems, and also there can be instances where you might have to restructure the company, the groups. Some of them are groups, so you might have to restructure the groups, the corporate structure, the balance sheet. So it takes time.
Right.
So that can actually take about a year and a half even sometimes.
It's time to go for a short break. We will be back momentarily. Welcome back to Going Public. Shahan, perhaps, we are on the topic of the first initial baby steps that a company takes. Anything that you want to add?
No, just to add to what Deshan and Darshan said. So although, you know, the rules allow companies which have only a 1 year track record of being in operations to list, typically going for an IPO is not something that's done by very new companies. It's companies that have evolved and have reached the mindset to be a public company, which involves, as what they said, having the right structures and corporate governances in place, and also having the right mindset with regard to public shareholders and giving, being determined to, you know, give them.
So what I'm saying is basically they are not the matured companies. They are not in their startup stage, but maybe they are privately held. But however, they are a company that has some history, financial history, at least a minimum of, I think in Colombo Stock Exchange is 3 years, is it?
3 years for the main board and 1 year for the
so actually board. Even after 1 year, you can list.
Theoretically, yes, but generally most companies that come have a much longer track record.
Right. So what are the options then? Is it equity, debt? How does that work out? How does the breakdown work out?
It again depends on where the company is and what the company's balance sheet looks like and what the expansion plans are. Typically in Sri Lanka there has been an aversion to debt, but debt is not always a bad thing. It's good to have a good amount of debt, manageable, healthy amount of debt on your balance sheet. But beyond that, especially as you grow, if you want some other investors, like-minded investors who want to grow that path with you, that's when you look at equity.
So how does how does the divide work? For example, is it the same process if you have a equity IPO and the same process if you have a debt IPO?
No, it's slightly different because processes for debt and equity are different. For a debt IPO, I mean, you can have an unlisted company which has listed corporate debt.
That's right. You list the debt.
Yes.
Instead of the
so
right.
the process for that in terms of disclosure requirements and things are much less than.
Which is
for
the easiest step?
Well, that would generally
So
be
would that
easier.
lend itself to the next stage of going public? Would you suggest to a company that, okay, you do it this way first and then you get on board as an equity, or does it work out, or are they kind of, what you say, not related to each other? Does it really, how does that divide work?
Actually, we actually we haven't seen much companies going out with debt loan as a first step. Generally, what we have seen is people go for listed debt once equity has been listed.
Or sometimes they go for equity and reduce their debt.
Yes, that has been one of the objectives of some of these issuers. Just to add to what Deshan said, yes, the debt serviceability has been a sort of issue for some of these corporates, so they have to have a right mix between debt and equity. But the serviceability, repayment of capital, repayment of interest is there. So as a result, some of these cash flows, if that doesn't sort of support that, then that's where people look at equity.
So once they say your client has decided that they're taking the equity route, they are mature enough, you guys have kind of come on board and cleaned up their numbers and restructured, or whatever you call it, and the company is ready. So what's the next step? Is it a prospectus, due diligence? How does that work out?
Yeah, I think as part of preparing for an IPO, an investment bank would do their own bit of due diligence. A lot of this work happens concurrently, so it's not
is it hand in hand with the investment bank, or do they have their own teams that they have to bring on, or is it completely they come to you and say?
Well, generally it is the investment bank that would lead a due diligence. Of course, there would be lawyers and auditors involved, but very much under the guidance of the investment bank.
Right. So you all know the whole process, you all guide the whole process, and you all hold their hand and take them all the way to the
That's right.
listing process,
Yeah.
right? Okay.
So in terms of a listing process, there is the legal work involved of preparation of prospectuses, and submission of financials and all the other information that the stock exchange would need before approving a listing. So that's something that we would help them with. And concurrently, on the other hand, what we would do is we would also start feeling out investors, do our own marketing material in terms of the company's best selling points. Our job would be to effectively frame the company story. It is always the company story, it's not our story. So our job would be to take the company story and present it in the most compelling manner to investors. And once the stock exchange actually approves the listing, then we would actually formally go out to these investors and convince them that this is a good investment to make, that the valuations that this IPO has come out on is reasonable and attractive. It's not just done by us. The company's assistance is vital, because investors most times don't want to talk to the investment banker. They want to talk to the company, and hear it from the company as to what their future plans are, how they see the industry shaping up, how they see the company's place within that industry, what risks are out there, and how is the company going to meet those risks. So these are the kind of things that I think we would help the company frame, so that it's put forward in the best light possible.
The percentage of shares that's going to be brought out, and the price of the share, of course, translates to how much the company can raise.
Yes.
So does that come together with how much the company wants, or how does that decision break down?
Yes, actually, that all depends on how much the company would want to raise. So once, as Shan and Deshan said, we carry out a forecast of the operations, looking at the business plans. So based on the business plans, we look at the cash flows and arrive at a valuation, and then look at the market sentiment also, and see at what price we can actually place. So the number of shares that will be issued to the market would depend on the amount they want to raise. So yes, so and also when preparing the issuers for listing, we would actually advise them with regard to the requirements, regulations, rules of the stock exchange, SEC and the Companies Act, and guide them, not at the time of listing only, but subsequent to listing also, what sort of rules and regulations they have to adhere to as a listed entity, and then what sort of governance they need to have towards the minority shareholders. They have to protect the minority shareholder rights. So we advise them on the whole gamut of activities with regard to such activities. So
the documentations and necessary requirements from the SEC perhaps, or the Colombo Stock Exchange, these are all undertaken by the Investment Bank Group.
Yes.
It's time to go for another break. We'll be back shortly on Going Public. Welcome back to Going Public. Yes, so we were at the process of, I think, due diligence, and post due diligence, what's the next to expect?
Post due diligence, normally what we would do is simultaneously with the documentation, where we would do the prospectuses and the documentation that you need to get the listing done. We would develop the equity story of the company and the valuation of the company, which Deshan, as Deshan said, the equity story is basically where we would work with the company to bring out their plans and pitch it in such a way that it would be compelling to investors, and valuation, as
How long is that process generally?
it all depends again on, but roughly about 6 months would be adequate for that process. But if there is a lot of restructuring that needs, then of course that will take longer time. But generally, to make application to stock exchange, a period of about 5 to 6 months would be adequate. So depending on the approvals, we might have to actually go to SEC also, depending on the approvals. Otherwise, it's primarily stock exchange approval.
So like Deshan was saying, is these things can happen concurrently. It's not a linear thing. It could be simultaneous while you're figuring out or restructuring certain parts of the company, or the books or the processes. You're also developing your story. Your analysts are writing it out. Perhaps your marketing guys are talking to possible investors. So all in all, you're looking at a process of 6 months to 1 year. You can bring out the company in the exchange.
Assuming there's no detailed restructuring that needs to be
come ahead first.
Come ahead.
Okay. So Deshan, so once you've gone through this process of doing the due diligence and sorting the company out, what is the next step?
Well, next in line is obviously the stock exchange approval for the listing, and it's really then that the exciting part starts, where it's what we call the roadshow, where we are out there talking about the company to different investors. It's also a very tiring time, because generally the company management would accompany us for these meetings. These meetings can take the form of a common forum where we talk about the company, like cocktails and presentations, then specific one-on-one meeting with institutional investors. And most times you're repeating yourself over and over again, the same story, but you want to always...
It gets better and better as you go.
Yes, you do learn, and a lot of company management have learned by talking to the first investor and second investor, what investors look for, and the third time, it becomes more refined. So you're doing a lot of these. You're meeting as many people as you can, talking about the company. In certain large IPOs, you are also looking at foreign roadshows, where you go outside of the country, talk to primary investors into Sri Lanka, again selling your story in terms of where you see the company going. So that process generally takes about 3 weeks, where you're out there all the time talking to investors. And then once you're done, then the investment bankers would then follow up with these investors, answer their ongoing questions, and hopefully convince them to subscribe for the IPO. So that's very much the exciting time and tiring time for the company. That's where it all comes down to, actually going out and raising the funds that you want. It's different degrees of difficulty, depending on the industry that the company is in, and the type, and I guess the state of the market at the time. But it's generally been quite a rewarding experience for most people.
So the road shows, the prospectus is basically done, the road shows take on its own life, as you said. So this is something that is shared between the lead manager, the partners. How does this process start? How many people are helping the company sell itself?
Well, it depends on how many investment banks the company wants involved. It generally has depended in the past on the size of the issue. Most issues have had one investment bank advising them throughout the process. Certain companies have chosen to have two, and in this case there have been cases where there are joint managers, where both investment banks are in it from day one, advising the company. And then there are other issues where there has been a lead investment banker who takes the primary responsibility, and a joint or secondary investment banker comes in later to help with actually the placement of the issue, especially in issues which are quite large for Sri Lankan standards.
Yes, generally the other investment bank is normally termed as co-managers generally. So it's the co-managers actually, as Dishan said, primarily get involved in the marketing aspects. Lead investment bank takes more responsibility with regard to the due diligence, valuations, getting the prospectus out, getting the approvals. So yeah, it's a combination of all these parties finally would result in the success.
Right. Okay, I just want one more question on the valuation side. We don't need to go into the details and nitty-gritties, but how does the company, you mentioned it several times, how does the valuation process begin? I mean, what is the valuation? How do you actually go out and value a company? On what basis?
Yeah, basically, I mean, there are many different ways of valuing companies. So, in the context of a IPO, there will be multiple factors that you have to look at. One is the market conditions and what other comparable companies or what the market as a whole is trading at in terms of valuations, and then you would try to benchmark the IPO accordingly. So generally IPOs will be pitched at a slight discount to their peer group in order to give some upside to the investors. But of course, if the company that's coming out is, say, a market leader in its segment, or it's expected to be a very large liquid company and can command a liquidity premium in terms of foreign investment and so on, then it might come at par or at a slight premium to its peer group. So in terms of an IPO, the valuation that most investors would look at would be the PE multiples, that's the price to earnings multiples, and the DCF values relative to
discounted cash.
Yes, discounted cash
right.
flows. Yeah.
Okay. Yeah. So then what part of the process is, for example, once you get your valuations done, the roadshows done, and the next step is?
Well, next step is hopefully the oversubscription of the issue on the day that it opens.
Right.
Most IPOs in Sri Lanka have succeeded in getting their IPO subscribed on opening day. There have been times where it takes a little longer, and that's not a bad thing. But it's primarily to get the issue subscribed, which is the most successful, which is the success of an issue. There have been certain issues which have been heavily oversubscribed versus a few times oversubscribed, which is not really the case, which is not really the concern. The concern is getting the issue oversubscribed. Once the issue is subscribed, then you would like to see the share trading actively in the secondary market. It could go up or down. Of course, investors are happier when the share price goes up.
Right.
But after the issue, the company's job is to keep running their business. It's not really to worry about their share price. And if the company runs its company, the management runs the company properly, then over time the share price would reflect what it's really worth.
Right. Getting back to the IPO day, or just post-IPO. So at what time does this now, as underwriters or as investment bankers to the issue, perhaps it is not oversubscribed, or explain the process to us? Who takes the risk?
It is really the company that does takes the risk, but it would be the expectation of the from the investment bank to know what is possible and what is not, given the market conditions, and where the investment bank has effectively advised the company, then it should get subscribed or close to it at least. But there have been times where at the point that you price the issue, at the point that you go to market, the market is very active and it's doing really well, and 2 weeks down the line the subprime mortgage crisis happens, and things don't work out as they are. It's generally the company that does take that risk, but if the goings remain as they are and the investment bank has advised the company effectively, then it should be subscribed at least by one time.
Thanks, Deshan. It's time to go for another break. We will be back on Going Public shortly. Welcome back to Going Public. Yes, Deshan, we are just talking about the IPO day and subscription, oversubscription, and perhaps devolvement or underwriting. Can you explain all those terms and the process? Yeah, well, oversubscription is where if you are looking to raise a certain amount of money, you have subscriptions for more than that, which is generally perceived as a sign of investor confidence in your share. There have been times, like I said earlier, where there has been undersubscription because of many market reasons, which is not the worst thing. You still do raise the funds that you wanted, or a part of the funds that you wanted, and you can still go on as you are, provided that you meet the certain minimum public float criteria at the stock exchange. Then things function as they usually would. So Shan, you share the same view on not being oversubscribed or sufficiently subscribed?
As the investment bankers, part of our job is to advise the company, as we discussed earlier. So part of the advice would be on the market conditions and how confident we are that the issue would be subscribed, or if we think it's undersubscribed, then we would generally recommend that we look at some other options of raising capital, or wait until market conditions improve, or we come at a lower valuation that where we can be more confident that investors would subscribe for the IPO. So you try to avoid situations where the IPO can be potentially undersubscribed, but in their cases it does happen. But like Deshan said, it's
a part and parcel of the process, because by the time you get to that gate, you're already quite sure
exactly
where you stand.
I think what happens is when we go out, if it is undersubscribed, we have to take already measures. So we need to look at the objective of the issue. If it is to finance some project, then of course for sure we need those funds. So if we don't get, then we have to look at the alternative, and then in the prospectus we would say how we are going to finance it, whether it's through internal generated cash or debt or otherwise. So if the company is not in a position to fund it through internal generated cash or debt, then of course in case of undersubscription, then we might have to underwrite it. So we haven't seen that happening, but if that is the case, then yes, we might have to underwrite it so that we are assured of the amount that we are going to raise to finance the project.
And generally it's underwritten by the investment bank, or is syndicated, or how does that how you manage that?
In this market, we haven't seen very many issues being underwritten. Sometime back in the early 90s, of course, we saw some issues being underwritten. But since of late, we haven't seen that. What happens is, in this market, we haven't seen exclusive underwriters. So if we have to underwrite an issue, then we need to go back to the banks. So in such instance, it might be better off for the company to arrange some debt facilities through the bank itself, rather than going to the bank to underwrite an issue. So in that sense, we haven't seen pure underwriters. So
Right.
It doesn't make sense
Right.
sometimes.
So leading up to the IPO, how does the cost get involved from the road shows, the prospectus, then there's advertising, how and who spends, and does it come out of the IPO later, or do people spend up front? How does that work out?
It does depend on the expense concerned, but most of the expenses do come after the issue, because it is really as a portion of the issue value that a lot of these costs are judged. But there are fixed costs involved. So as always, the larger the issue, the smaller the percentage cost becomes.
Right.
And it really depends on how much the company wants to get out of the IPO. For example, certain companies, when they do go public, they use that as an opportunity to market themselves. Not only the share issue itself, but also the company profile and brand the company as something that is totally different. Now it's listed. For example, we had all the recent issues, Laughs Gas, People's Leasing, where they use the IPO also as a brand exercise to establish themselves. So it's really how much the company also wants to get out of this exercise. Then there are the mundane expenses, the registrars, the legal fees, and all of that, which is really a fixed cost.
Right.
So it depends entirely on the size of the issue.
Right, so basically the larger the issue, the smaller the percentage of fees, and of course you don't need to go to Singapore, New York and London. If it is not a huge amount, you all raise the capital in locally itself. Darshan, yes, so now we talked about the topic of oversubscription, subscription, and perhaps even falling short. So obviously the IPO is dependent on how successful perhaps the roadshows are, and what are the investors looking for in roadshows? What would you advise companies who want to raise capital?
The investors would primarily look at the business the company operates in, the industry, how strong your balance sheet is, and what sort of business plans the company has, even with regard to the management skills, whether the management is capable of running the company and taking the company through the next phase of growth. Because some of these companies are privately held companies, they would want to know the business continuity, succession plans. So these are some of the things we want to say. Who is next? Has the company groomed anyone to take over from the original management? These are some of the things they would want to ask. And of course, with regard to the returns, these are of course these are some of the primary basic things they would like to see. They would want to see what sort of capital gains, what sort of dividends, so they would want to know what the dividend policy of the company is, whether the company has a track record of paying dividends in the past. So they would want to know what the dividend policies are also. These are the things they would want to look at primarily, and also would want to know who the investor base would be, whether we are pitching only at fund managers or retail. So they expect to have a mix, a good balance between retail and fund managers, because they subsequently, when the stock is traded, they want to see secondary market activity as well. What happens is, if it is concentrated more towards fund managers who are long-term investors, then there would be hardly any secondary market trading. But if there are retailers coming, they would want to have a good they would want to trade immediately and if possible get a capital gain. So they would want to know how much is allocated for the retail segment, how much for long-term investors, how much for unit trusts. Now of course the stock exchange, they have predefined amounts of IPO that needs to be placed placed between retailers, unit trusts and non-retail category.
So ideally, obviously nobody is looking for people who wants to come in on the IPO and the next day sell the share. I mean, what is the basic the balance that you all look for? Investors who are long-term and institutions who want to support you throughout and just not get out immediately. How do you all advise companies on that?
Well, it really does depend on what type of a company it is. But ideally, you want to have a mix of retail investors, high net worth investors, and institutions. Institutions traditionally have been known to be the long-term investors. So you would like to see a pretty reasonable size of institutional investors buying into your company, because they are then they provide two things. They provide stability, and when later on when you want to raise a second round of capital, you know that the institutional investors have deep pockets, so that they would always be able to support you in that cause. But you also want to see your share being traded, and a lot of the shares being traded are primarily driven by the high net worth individuals and retailers. It's not a bad thing for people to sell your share the next day, provided that as a reason for it. If the share price has gone up, then it is of course viable that the investor would sell. But you want that activity going on, whether it's up or down. You do want people trading your shares, because then that then also actually helps the institutional investor. Because when he or she wants to sell down, they know that there are people who are there to buy their shares.
So post IPO, what do the investment bankers do with the company? Is it hands off after that, or what's the story?
Generally, we do try to advise. See, the formal undertaking of an investment bank does finish at the point that the IPO closes, but most investment banks do maintain good relationships with the companies concerned, and we generally try to push them towards a reasonably good investor relations program, because it's not only about raising money the first time. You want to keep your investors happy. You want to communicate with them. Of course, there are formal
and of course
means.
You might want to go back to the market again,
Exactly.
and raise more capital.
Exactly. And you want to, and that dialogue is very important, because the investor knows that the management is focused, is on board, they know what's happening. Of course, you do not, there are certain guidelines as to what you can disclose and what you can't, but within those guidelines, a good effective investor communication is very important.
So obviously another fear factor would be the regulatory aspects. Does the investment bank advise the company on that also?
Well, for companies that are listing, I don't think there are that many regulatory
post-IPO.
Post-IPO,
yes.
I don't think there are that many regulatory aspects that they need to be very concerned about, except now there are new rules on maintaining free float and
independent
and so on.
directors
And
so on and so on.
And,
But who advises them? Is the company is it a part of
normally
IB's process,
the company secretaries and their lawyers plus the investment
Right.
banks would also
Right.
advise on those things.
So
Actually, that will be one of the key roles at the time of preparing them for IPO,
Right.
to make aware.
So all these teams come together and basically prep the company as to what
That's
is
right, yes.
involved before the IPO, and then of course IB's role is literally making sure it gets subscribed and the valuation is right.
Yeah.
If I'm taking the right thing off of this, of what I've been describing, and post IPO, hopefully the share rises and the investors also get a return. Then, if you maintain good relationships with the market, the process becomes easier, is it? I mean, you go for a secondary offering, you can also go for a debt listing and create, once you have set up the governance, and once you have set up the process of being more transparent to the public, being public listed actually means being more transparent. It becomes easier as you go along. I think we covered quite a lot, and I thank you for your presence here and educating us about the whole process of going public. And back to Amaya, and thank you for watching us.
Thank you, Vasila. There you go, another key player when it comes to an IPO, dissected on today's program of Going Public. Investment banking as a very important factor when it comes to listing your company on the Colombo Stock Exchange. With that, we wrap up this week's edition of Going Public, and we will see you next week with another great episode as well. Till then, take care.